Bloomberg Audio Studios.
Podcasts, radio, news.
Dutch Central Bank President and ECB Governing Council member Klaas Knot joins us now. And Governor, President, all of the different ways that you weigh in on European Central Bank policy, what a fraught moment. How much are you looking to U.S. policy to determine how far the ECB can go on its own?
Well, obviously, monetary policy always takes place in a global context. But at the same time, we're not the 13th federal district. We have our own monetary policy. We have our own set of outlooks, economic outlook, inflation outlook. And as Christine already alluded to, some of the fundamental drivers of inflation have developed quite differently in the US than in the euro area. So we have our own monetary policy to do. That monetary policy, I think, is testimony of the fact that we're increasingly confident with the disinflation process that we have been seeing and that we expect to continue. We expect it to become a little bit more bumpy also down the road because of all kinds of technical factors that I won't want to tire you with. But we are confident that the overall picture is one of continued disinflation.
So you mentioned the B word, bumps, and this is something we hear a lot. What kind of bumps would you have to see to not cut rates in June?
Well, bumps that would lead me to fundamentally change my assessment of the ongoing disinflation process. And I think the projections that we have are pretty clear, that we are moving toward reaching our target 2% inflation over the medium term in the remainder of this year, course of 2025. But there are risks surrounding such projections. But increasingly, these risks are becoming more balanced. Upside risks, I think, emanate predominantly from the labor market. And then it's not just about wages, it's about wages in combination with very slow productivity growth. That's also a major difference with the US. And the question about the capacity of firms' profit margins to absorb any increase in unit labor costs that might come from this combination of wages and productivity growth. That's the assessment we need to make. That's a risk on the upside. At the same time, we also don't want to undershoot our inflation target. We have a 2% symmetric target. We are zooming in on it, and let's make sure that we continue to do so.
So right now the market's pricing in a 25 basis point cut in June and then 2 more for the remainder of the year. You're basically on board with that if everything stays the same.
Well, I'm not uncomfortable with such market pricing, but at the same time, we don't pre-commit. We're data dependent. We go meeting by meeting. Of course, we have a picture of where we think the underlying movement is within the data. But we will have new data points, every month on inflation, every quarter on the labor market, and that will continue to inform our decisions beyond June.
Well, what would make you rethink what you have right now in terms of that path? Is it the geopolitical concerns? I'm trying to understand what would make the ECB change path, or how would they respond to, say, an oil price shock?
Yeah, well, an oil price shock obviously will lift inflation. That is absolutely true. But the question for us is the oil price shock of enough significance to trigger second round effects? And there's an important difference here today with 2022. In 2022, all inflation items were going up, and we had the energy price shock as the consequence of Russia's unjustifiable invasion of Ukraine. Now, if we have an oil shock, it will be against the backdrop of general disinflation in all the other factors. So the likelihood of significant second round effects, I would argue, is smaller, but it is clearly something to monitor. It's clearly something to keep in mind.
So you're willing to potentially look through it?
If it continues to be confined to energy prices only, yes. As soon as I get indication that it broadens into the consumer basket into more traditional goods and services inflation, then the answer would turn no.
Something that people have speculated is that the ECB might be willing to also look through depreciation of the euro in response to rate cuts at a time where the Fed is not cutting, as long as there isn't an oil price shock. So let's say that there isn't an oil price shock. Would you be willing to accept parity with the euro and the dollar? All things being equal, it's fine.
Well, the exchange rate in and of itself is not a target of our policy, so I can't comment on specific levels of the exchange rate. It's one input into our overall assessment of the inflation outlook. It's clearly that a depreciating currency would lead to additionally imported inflation. At the same time, if the reason for that is tighter monetary policy in the US, higher bond yields in the US, that would also spill over to the euro area, and we would have tighter financial conditions in the euro area as a consequence of that. Which of the two effects will dominate? It remains to be seen. That's very much state contingency, so that's difficult to comment on beforehand.
A very difficult question. Some people are speculating that high rates are actually helping inflation continue because people are earning more and then they're able to refuel that into the economy, and that low rates actually were depressive of inflation. Do you believe that?
No, I don't believe that at all. I think it runs counter to decades of empirical evidence, and if you want to see what the consequences are of running such an experiment, look at Turkey, right? I mean, that's where the experiment was brought to life, and I don't think that that's seen as a paragon of central banking success.
Dutch Central Bank President, ECB Governing Council member Klaas Knot, thank you so much for being with us. Really appreciate it.